Very, very important video here today, folks. We're talking about stopping buying stocks moving forward. This is an important subject, and I know it's on a lot of folks' mind right now. The NASDAQ has climbed almost 17% just since the beginning of November. S&P 500's up 11% just since the beginning of November. I'm sure your portfolios have reflected how well the market's really doing, right? I know the public account alone is up over $400,000 just in the past month or two. Less than 2 months, that account's climbed over $400,000, right? And so it's very natural that everybody's looking at the market right now and they're like, is this market expensive now? Am I getting ripped off if I'm buying stocks? Are we about to have another bear market? Are we about to go down a bunch? I'm going to get better prices here soon, and those sorts of subjects, right? And so I got so much to show you in today's video that's going to, I think, kind of shape a lot of folks' minds and kind of understanding what's going on in the market. Are you getting good pricing on stocks? Are you getting poor pricing right now? And also kind of diving into what I'm going to personally do. I'm going to tell you, am I pulling back on buying moving forward? Am I going to keep buying aggressively, right? I used from basically the summer of 2022 throughout the entire 2022, I just bought like a maniac, right? And so now, obviously, a lot of stocks have come back quite strong. Am I going to pull back? And so I'm going to share all that in this video. I hope you get a tremendous amount of value out of today's video. I think it's a video that's going to be relevant whether you're in the market right now or, you know, in 5 years from now or 3 years from now or 10 years from now, okay? I appreciate every single person that's subscribed and joins me for the videos all the time, okay? And also, just so you know, our once-a-year sale for Becoming Master Stock Market and Dividend Investing Mastery that is about to end here in the next few hours. If you want access to that course, go ahead and check out the pinned comment down there. This helps with finding great growth stocks, understanding if a company has great or poor financials, finding undervalued stocks, knowing how to build a great portfolio of stocks, making consistent cash flow from dividend stocks, knowing if companies will likely raise or cut dividends, understanding when to buy and when to sell, and know what to look for in the next great growth stock. It covers a ton more subjects than that. Those are just some of the key ones that if you need help with any of those, they can definitely help you out tremendously, okay? By the way, I'm losing my voice a little bit, so I might not be able to talk super loud in this video, okay? I do apologize. Now, before we get into all the important stuff, I just got to make you guys laugh a little bit because these are some funny things I saw, okay? I saw somebody post this on Twitter. In 1958, Warren Buffett bought this house in Omaha for $32,000, which he still owns. It's now worth $650,000. If he instead slept on Charlie Munger's couch and invested those funds into Berkshire Hathaway, it'd be worth $1.2 billion. Lesson, don't buy real estate. I mean, you know, this part comedy, part fascinating at the same time, right? And look at this. I think Elon Musk is trolling hard, okay? I got to be honest, okay? So I went to Michael Burry's profile on Twitter yesterday. I was just curious, okay? And look what the #1 account is on who to follow when you look at Michael Burry's account. ARK Invest? Are you kidding me? Are you kidding me? I swear Elon Musk is the ultimate troll. There's no way you can tell me that man's not messing around in the algos and telling some employees to do this. Come on, man. Come on Michael Burry, like, you know, if anything, it should have like another like short seller. I don't know, Jim Chanos' account or whoever suggested. The fact that the suggestion is ARK Invest. Come on, man. You're going to tell me Elon's not up to something there? That's trolling level 1 million right there, okay? Alrighty, guys. So let's get into the serious nature of this video, stopping buying or not, okay? So I think first off, the worry that I think comes to people's minds, okay? I think it's, you know, I've always been fascinated with psychology and the way the brain works in humans and decision-making and those sorts of things, right? And so I think bigger than money, I think the reason a lot of people worry about this, right, more than the money, is just being the sucker, right? And they're looking at this and they're like, if I'm buying right now, especially with how much stocks have gone up recently, am I a sucker for that? Am I making a bad financial decision? And people get more embarrassed to buy stocks high than to miss out on opportunities when stocks are low, right? Because they look at it and they say, well, everybody missed that deal because if, you know, everybody would have been buying that stock if it was low, right? So a lot of people weren't buying stocks in 2008, 2009, 2010, and they're fine with that, and they can look themselves in the mirror despite having that ability to do that, right? And they say, oh, you know, it's okay because a lot of other people weren't buying, and so they don't feel like a sucker. But yet the person that buys a stock high, right, and the stock goes down a ton, those people feel like a big sucker in the end, right? Really, I can tell you the people that are a bigger sucker are the ones that weren't buying in 08, 09, 2010, and every single other time you get a stock market crash out there, right? But those aren't just traditionally what's made fun of or in pop culture or anything like that, right? It's more like, oh, the person that bought whatever asset super high, right? They're such a sucker for that. And so I think that's what it comes down to more than the money. I think it's more about ego and pride than anything else in the end, right? Now, let me dive into a few stocks here and show you this from a few different perspectives, okay? So if we look at a stock like Meta, since the beginning of November, this stock is up 95%. 95% in about, let's just say 3 months or so, okay? 95%. It's incredible, incredible gain, right? And so you could look at that and say, man, Meta stock is so high. It's got to be so overvalued now. The stock has climbed 95% in such a short period of time. That's ridiculous. Like if a stock goes up 20% in a year, that's great. 95% in 3 months, that's just ridiculous, right? Well, let me show you this, because this might change your mind a little bit. Oh, no, this is just going to make your mind even go there even more. Okay, $98,000 we're up in the public account. No, that might mean it's even more overvalued. This might change your mind a little bit, okay? Check this out. This stock is down 53% from where it was in 2021. And by the way, it wasn't even overvalued in 2021. There was a lot of stocks that were heavily overvalued in 2021. Meta was not one of those, okay? This stock is now 53%. So is Meta stock still so high? Because we can always cherry pick data and show, oh, wow, it's up so much in such a short period of time. It's way overvalued. Well, let's back it up to where it used to be. It's now 53%. Doesn't look so high now, right? But that's not really how you judge valuations on stocks. You can't just look at a chart and say, well, it's up so much or it's down so much or, this means it's overvalued or undervalued. You got to really look at where earnings are at in PE ratios, right? Well, the fact is, Meta trades at a forward P of 18. And by the way, I think that number is actually lower than that because I think they're going to come in with better earnings than Wall Street's expecting on average in 2023. But 18 for a company with this sort of growth? I mean, there's companies out there that are trading in the Dow that are trading at significantly higher valuations on forward P basis that don't have even remotely close to the opportunity Meta has over this next decade to grow their business. Like Meta should be able to easily double or triple up their revenue over this next decade. There aren't a lot of Dow stocks that are going to be in that sort of position, right? And it's trading at an 18. This stock is significantly undervalued. One of the best companies in the world, one of the best balance sheets in the world. I mean, one of the biggest game-changing CEOs in the world, and an 18 forward P, extremely undervalued still, okay? Extremely undervalued in regards to Meta. You look at a stock like Tesla. This stock has climbed 99%. 99% since the beginning of this year. Okay, this is a year-to-date for Tesla. Tesla, my Tesla, right? 99%. So you look at this, I mean, anybody that's just certainly bearish or short sellers of Tesla are just going absolutely mad with this whole situation, right? It's so overvalued. This is so ridiculous. Look at how much the stock's gone up. This is stupid, blah, 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 right? It looks so expensive, right? Somebody like myself, I make this stock look cheap, right? I mean, my cost basis here on these shares is $39,000. Those shares are now worth $356,000. That's an over 800% gain, right? I mean, it's on its way to be a 10x type position, right? But what if I backed it up a little bit? What if I showed you since 2021, this stock is actually down 47%? You might look and say, wow, Tesla's so cheap, actually. This is actually a great price if I buy Tesla. But it doesn't really work like that. We got to look at valuations, right? And what is the valuation of Tesla really telling us? It's actually telling us Tesla's still cheap. It's not dirt cheap like when it was $103, $101, $105 last month. But this stock is still very cheap. Now, you might say, wait a minute, it's a 48 forward P. Meta's at an 18. The stock market in general trades at a 15 to 20. How can you call this stock cheap? This is ridiculous. This stock's clearly massively overvalued. It trades at, double, almost triple what the market trades at, okay? I'll explain to you exactly why the stock is epically cheap. The fact is, most stocks in the stock market are lucky to grow their revenues by, 4 to 5% a year. Tesla 10x's those companies. Tesla's growing their revenue by 40 to 50%, okay? So if anything, you should be able to say Tesla commands at least a 10x valuation premium on a forward P versus a market. Meaning if the market trades at a 15 forward P on average. Tesla stock should be trading at 150 forward P, because if it's 10xing revenue and they got those sorts of margins behind the company, it should trade at 10x the forward PE as well. Okay, and so the bottom line is, you could make an argument if 50 forward P is fair, or 100 or 150 or 200, but the bottom line is, we're at the very, very let's call it undervalued stage of Tesla still at this point in time. Okay. There was a time period when Tesla was trading at a forward P of, let's call it 150, 200, right? And that's when the stock was overvalued at that particular time. But it's not anymore, okay? It's not anymore. And so the bottom line is, in regards to Tesla stock, this stock is still cheap. Not dirt cheap, but it's still cheap, okay? If you look at a stock like Palantir, right? Palantir, you might say, wow, this stock is so expensive now. It's climbed 69% in a matter of snap of fingers, okay, 69%. Huge move. I mean, we were just red on Palantir a few days ago. Literally just a few days ago, I was red on Palantir. And now I'm up $10,000 in a matter of a few days on this stock, right? And so you may say, this stock is so expensive now. Well, what if I show you where the stock was in 2021? This stock is down 60, almost 65% since then, okay? Almost 65%. So if we're just going to look at stock charts and cherry pick data, I can show you this stock is actually extremely cheap on a stock chart basis, right? I mean, gosh, it's down 65%. But we got to look a little deeper than that, right? We got to look at the valuations. So in regards to Palantir, it trades at about a 55 roughly forward P in the stock, right? And they should have 18 cents of earnings. That's according to 15 analysts, and who knows, maybe they'll bring up their numbers over time, right? But 18 cents is what's expected. Run the math on that. You're at about a 55 P roughly, okay? So 55 P. Is it expensive for the market in general? Yes. But let's not forget, Palantir is like, they literally just got to profitability. Like, this was the first quarter ever they had like GAAP profitability, right? Alex Karp's talking about 2023 is going to be their first year ever to be GAAP profitable. That's a huge like stepping stone in the right direction, right? They just got here. So imagine the growth this company is going to have in their earnings per share, in their net income over this next decade. Like, they just are getting here at this point in time. This is like the infant stage of like growth of Palantir in terms of their bottom line, their profitability. And we know Palantir long term, even once they reach major profitability, which isn't going to be for probably another 5 years, 10 years in terms of like huge profitability that is, right? Even once they reach there, the company, because of the sector they're in, and because of how sticky this business model is going to be, they're going to be able to command a 30 to 40 forward PE moving in the future, okay? A 30 to 40. And so when you add up the numbers on what this company's net income is going to over time, right? This is a company that will hit $1 billion plus in net income, and then likely several $1 billion in net income, in my opinion, right? And so slap a 30, slap a 40, PE on that. Well, right now we're at a $20 billion market cap on $1 billion market cap, if not $100 billion market cap on this company over time. Expensive at a 55 forward P or so, but actually when you're in the infant stage of profitability, you're actually extremely cheap. Remember when Tesla just first reached profitability, right? It was trading at 50, 100 forward Ps. And then we found out, oh gosh, that's extremely cheap for this company because they have so far to go with margins and profitability, right? Now, let me take you a step deeper. Let's look at some charts here, and I got one to show you that's going to absolutely blow your mind, okay? So, forward P on the S&P 500 large cap, 18. We're definitely still in richer territory, right? You're not getting great pricing for large caps. There's a bottom line. So if you want to say the stocks that maybe aren't the best opportunities, it's the large caps, okay? It's a lot of the Dow stocks. Those ones you're just not getting good pricing. And so for those stocks, if you want to pull back on buying those, it kind of makes sense, right? There's just not a lot of opportunity there. But there's a lot of opportunity other places, like right here. Let me show you this, okay? Mid caps. A lot of opportunity still in mid-cap land. We're still trading very undervalued from where we usually trade it when it comes to mid-caps, okay? S&P 600 small caps. Small cap stocks are still a steal deal in this market. Have they come back a lot recently? Yes, absolutely. But the bottom line is look at the historical trend and look where these stocks are at. They're still very undervalued. Mid caps and small caps is where it's at. That's where you're going to get the best pricing in this market. Doesn't mean there aren't certain opportunities in large cap space, because there are. It's just, I'm telling you, a lot of those Dow stocks are not undervalued. They're fairly valued, or they're overvalued when it comes to those stocks. The real opportunities are here or in some of the bigger tech stocks out there, okay? This chart is going to absolutely blow your mind. And I shared this with the private stock group earlier in the private wealth group, right? Because if price to earnings growth, okay, the best way to think about price to earnings growth is usually if you can get a price to earnings growth ratio on a stock under 1, you're usually buying an undervalued stock. It doesn't work perfectly like that, but it's usually undervalued, right? And the more you have to pay for a price to earnings growth ratio, usually it means it's bad, okay? And you usually want to try to get the ratio to be as low as possible when it comes to price to earnings growth ratio, okay, PEG ratio. But this chart's going to blow your mind, because this is going to take everything you ever learned about PEG ratio and completely throw it out the door, okay? So if you look over time, the best time to buy stocks, at least since I've been in the market since 2008, right, is actually when the PEG ratio is extremely high, which completely goes against everything you're taught in regards to PEG ratio, okay? Look at where the PEG ratio was in 2009, 2010. There was a best time period to buy stocks in the last 40 or 50 years, okay? The most extraordinary time to buy stocks in the last 40 or 50 years was right here when the PEG ratio went sky high. It went above any of the ranges. It went above even when, before the tech bubble. That's crazy, right? If we look at around this time period, 2015, 2016, PEG ratio went to the moon. A lot of companies were having trouble increasing profitability at that time. Growth was slowing. China was slowing. It was a confusing time period, right? PEG ratios went really high. It was a tremendous buying opportunity. Look where your favorite stock was in 2015, 2016, and look where that stock is today. Look where those companies' net income were in that day versus today, okay? Look where NVIDIA stock was at this range. Look where AMD stock was at this time. Look where Tesla stock was at this time. Look at where almost all these stocks were back then versus where they are today. Apple, Microsoft, anything. And you'll be like, oh my gosh, that was an extraordinary buying opportunity. When the PEG ratio looked sky high, it looked like, oh, you shouldn't be buying right now, right? Look at right here. This is, a kind of around spring, summer of 2020. Extraordinary buying opportunity, right? Extraordinary buying opportunity. And the PEG ratio was the highest we've ever seen pretty much in history. That's incredible, right? And recently, the PEG ratio went to the moon. And we'll see. The story has to play out here. But you could be getting potentially the best pricing you'll get on stocks for many years right now. And an extraordinary opportunity. And so it kind of goes against everything you're really taught in the market. And this is why it's so confusing, right? And at the same time, you could look at some of these other time periods where, in the past, right, you could say, well, right here, PEG ratio was high. It wasn't necessarily a great time to buy. But that was also the tech bubble. So that might have been a freak situation here, okay? PEG ratio went pretty high right here. That was another great buying opportunity. PEG ratio was pretty high right here, 03, 04. It's actually a great time to buy stocks, right? So, and look at this. This is a horrible time to be buying stocks, right? Around here, when PEG ratio went actually really, really low. This is like 2007, early 2008. Horrible time to be buyer stocks, and it went really low, right? Look at right here. PEG ratio was on the floor. This was a horrible time to buy stocks. What happened right after this when the PEG ratio was super low? Oh, the best companies in the world fell 30, 40, 50, 60, 70, 80%. So you can look at this and you say, this must have been a great buying opportunity right here. It was actually a horrible buying opportunity. And so this is one of those charts that I just think is one of the most confusing things in the world, because it goes against everything you're taught in regards to this, right? Everything you're taught. So in terms of me, right, how do I view this? Am I going to start pulling back on buying? Am I going to keep buying the same? Those sorts of things. And my take on this is keep buying, okay? I'm going to absolutely keep buying out there in the market. There's no slowdown from me. I'm just going to, keep buying undervalued stocks that I think are great opportunities over this next 3, 5, 7 years. If I get any short-term dips in any of these stocks, I'll gladly take them. I'll gladly take them. If Meta goes down to 150, I'll take it. If Tesla goes down to 150, I'll take it. Like, if I get any of those opportunities, I'll gladly take them. But at the end of the day, like, I just got to keep buying out there in the market. There's a high probability many of these companies' margins and earnings per share increase quite substantially as this year ticks along, and I got to be there to take advantage of that. Hope you guys enjoyed today's video. As always, I appreciate everybody that subscribed to the channel. Make sure you get that deal before it ends, folks. That is our once-a-year sale for Become a Master Stock Market. Make sure you invest in yourself. You're going to learn so much from that course. It's absolutely insane, okay? Take advantage of that before it ends. That will be pinned comment down there. Thanks for watching and have a great day.